Welcome to the Money Context, where we explain how money systems work. If you find this kind of explanation helpful, consider subscribing. This channel is about clarity, context, and understanding how economic systems actually affect everyday life in the United States. For a long time, there's been a simple promise attached to work in America. Work hard, work full-time, stay responsible with your money, and in return, you should be able to live a stable life. That idea shaped generations of expectations. It shaped how people planned their careers, how families thought about stability, and how society defined financial responsibility. Full-time work was not just a job. It was supposed to be the foundation of security. But for many people today, that promise feels less certain. Across the United States, millions of people work full-time jobs and still feel financially stretched. Paychecks arrive regularly, work schedules are full, and responsibilities are met, yet stability often feels just out of reach. This creates a quiet question many people carry privately. If I'm working full-time, why does life still feel financially tight? To understand this feeling, it helps to step back and look at how the relationship between work and financial stability has changed over time. In earlier decades, a full-time job often supported a very different economic environment. Wages, living costs, and expectations were structured differently. Housing was generally more affordable relative to income. Healthcare costs were lower. Education was less expensive. Debt levels were lower for many households. A single income could often cover the basics of life: housing, food, transportation, and savings. That didn't mean life was easy, and it certainly didn't mean every household experienced stability. But the economic structure made full-time employment more closely connected to financial security. Over time, that structure began to shift. One of the biggest changes involves the relationship between wages and the cost of living. In many sectors of the economy, wages have grown slowly compared to certain essential expenses. Housing prices have risen in many cities. Healthcare costs have increased significantly. Higher education has become far more expensive. Childcare, insurance, and other essential services have also become larger parts of household budgets. When the cost of essential goods and services rises faster than wages, the gap between income and expenses gradually widens. This doesn't happen overnight. It happens slowly, over many years. But eventually people begin to feel it in their everyday financial lives. A full-time paycheck may still cover basic expenses, but it leaves less room for savings, emergencies, or long-term planning. Housing is often the most visible example of this shift. For many households, housing is now the single largest monthly expense. Rent or mortgage payments can consume a significant portion of income, especially in areas where housing demand has increased faster than supply. Even people with stable jobs may find that housing costs alone take up a large share of their paycheck. And once housing consumes a large portion of income, the rest of the budget becomes tighter. Food, transportation, utilities, insurance, and healthcare still need to be covered. Unexpected expenses still occur. Savings still matter. Retirement still needs planning. When the margin between income and expenses becomes small, financial stability can start to feel fragile. Another factor shaping modern financial pressure is healthcare. In the United States, healthcare expenses can be unpredictable. Even people with insurance may face deductibles, co-payments, or unexpected medical costs. A single medical event can sometimes create significant financial strain for households. That uncertainty can make financial planning more difficult. Transportation is another area where full-time work intersects with daily costs. In many parts of the country, commuting to work requires owning and maintaining a vehicle. That means car payments, fuel, insurance, repairs, and maintenance all become necessary expenses tied directly to employment. In other words, the ability to work often depends on maintaining the transportation needed to reach the job. When all these expenses are combined, housing, healthcare, transportation, food, insurance, and other essentials, a large portion of full-time income can be allocated before savings even enter the picture. This leads to another important change in modern financial life: the role of debt. For many households, borrowing has become a way to manage the gap between income and expenses. Credit cards, personal loans, auto loans, and other forms of credit allow people to spread costs over time. In some cases, this can be helpful and practical. Loans can allow people to buy homes, attend school, or invest in opportunities that may improve their future income. But borrowing can also become a tool for managing everyday financial pressure. When unexpected costs appear, credit often fills the gap. Over time, that borrowing becomes part of the financial structure of many households. It's important to understand that this pattern is not simply about individual choices. It is also connected to larger economic trends. As the cost of certain essentials increases and wages grow more slowly, the financial margin inside a full-time paycheck becomes smaller. When that margin shrinks, households often rely more on credit to maintain stability. Another shift in the relationship between work and stability involves job structures themselves. The modern labor market includes a wider variety of employment arrangements than in previous decades. Some workers rely on contract work, gig work, or temporary positions. Others may experience frequent job changes or shifting work schedules. Even for people with stable employment, benefits like pensions or long-term guarantees have become less common in many industries. This means financial planning increasingly depends on individual savings and investment decisions rather than long-term employer guarantees. Retirement health care and emergency funds often become personal responsibilities instead of institutional ones. This doesn't mean full-time work has lost its value or importance. Work still provides income, opportunity, and stability for millions of people. But the economic structure surrounding work has evolved. Financial stability now depends on a wider range of factors than simply holding a full-time job. Interest rates influence borrowing costs. Housing supply affects rent and home prices. Healthcare systems affect medical expenses. Education costs influence student debt. Economic cycles affect wages and employment opportunities. These system-level forces interact with individual effort in complex ways. That's why financial pressure can exist even when someone is working responsibly and consistently. When people hear statements like, "the economy is strong," those statements usually refer to large national indicators, such as employment rates, economic output, or overall economic growth. Those indicators measure important aspects of the economy, but they don't always reflect the everyday financial experiences of individual households. A country can have strong economic growth, while many families still feel financially stretched. That gap between national indicators and personal experience can sometimes create confusion. People may wonder why economic headlines sound positive while their own budgets feel tight. Understanding the structure behind the economy helps explain that difference. Large economic systems measure averages and aggregates, but individual households experience the economy through their personal budgets, local housing markets, and daily expenses. Those two perspectives don't always move in perfect alignment. Another important factor is expectations. Over time, societies develop expectations about what a stable life should include. Housing, education, healthcare access, transportation, and retirement planning all become part of the idea of financial stability. As those expectations evolve and expand, the resources required to maintain them can increase as well. For many households today, stability means more than simply covering basic necessities. It also includes saving for the future, managing debt responsibly, and maintaining a safety margin for unexpected events. When income barely covers essential expenses, achieving those additional goals becomes more difficult. that can create a sense of financial pressure even when someone is doing everything that traditional advice recommends: working full-time, budgeting carefully, and avoiding unnecessary spending. This is where perspective becomes important. Financial stress is often interpreted as a personal failure. People may assume that if they are struggling financially, it must mean they're doing something wrong. But economic systems are complex structures. They include labor markets, financial institutions, housing markets, policy decisions, and global economic trends. Individual effort matters greatly, but it exists within a larger framework. Understanding that framework doesn't remove responsibility, but it does provide context. It helps explain why financial stability can feel harder to achieve even when people are working diligently. It also helps explain why many households feel similar pressures at the same time. When housing costs rise across many cities, millions of people experience the impact simultaneously. When healthcare costs increase nationwide, households across the country adjust their budgets. These are systemic changes, not isolated personal situations. Recognizing this broader picture can shift how people interpret financial stress. Instead of seeing it purely as an individual struggle, it becomes easy to understand it as part of a larger economic pattern. The goal of understanding these patterns is not to discourage work or responsibility. Work remains one of the most important paths to opportunity and stability. But understanding the broader system helps explain why the relationship between work and stability can feel different today than it did in the past. Full-time employment still provides income, structure, and opportunity. But financial stability now depends on a combination of factors: wages, living costs, debt levels, housing markets, healthcare systems, and economic policy. When those elements shift over time, the experience of work changes as well. The important thing is to see the full picture. Economic systems are constantly evolving. Policies change. Industries evolve. Technology reshapes labor markets. Global events influence supply chains and prices. These changes ripple through the economy and eventually reach individual households. Understanding how these forces interact does not provide instant solutions to every financial challenge, but it provides something equally valuable: clarity. Clarity helps people interpret economic news more realistically. It helps them understand why certain financial pressures appear at specific moments. And it helps place personal financial experiences within the larger system that shapes them. Full-time work remains a central part of economic life in the United States. But the relationship between work and financial stability is no longer as simple as it once seemed. Today, stability depends not only on effort and responsibility, but also on the broader economic environment in which that work takes place. Recognizing that complexity is an important step toward understanding the financial realities many households experience today. Because when people begin to understand the system around them, they gain perspective. And perspective changes how we see money, work, and stability. For more calm, fact-based explanations about how economic systems shape everyday life in the United States, consider subscribing to The Money Context. Understanding the system changes how you see money.